Solana is faster, cheaper, and growing larger than most ecosystems in crypto. Yet its coin Sol is down more than Bitcoin, Ethereum, and XRP. Is Solana superior technology with a broken coin, or is it misunderstood by the market? I spent many years of my career in investment banking analyzing the price of assets that disconnect from fundamentals. Today, Solana is a textbook example of that disconnect. And to understand it, we need to separate three things: the institutional use case, the technology, and the coin itself. They are three different assets. Let's start with what Solana actually says about itself. This is the Solana homepage. It does not describe itself as a cryptocurrency. It says the capital market for every asset on Earth. This is a direct challenge to Wall Street's infrastructure, not a promise for the future, a positioning statement for right now. And Wall Street is buying it. In December 2025, Visa launched a USDC settlement program in the United States, enabling US banks to settle payment obligations directly on Solana blockchain 7 days a week. By end of 2025, that program had already reached a $3.5 billion annualized settlement volume. JPMorgan arranged a $50 million commercial paper issuance settled in USDC directly on Solana for Galaxy Digital, the crypto investment bank. And Goldman Sachs disclosed $108 million in Sol token holdings. The important question is why those Wall Street giants are choosing Solana over other crypto ecosystems. The answer is in the technology. Most blockchains work like a line. Every transaction waits its turn while the network agrees and authorizes it. Solana solved that differently. It built a technology called proof of history that proves the sequence of transactions without coordination of the validators. The result is that Solana can process thousands of transactions simultaneously rather than one at a time. That is why it is faster. Let's see how much faster Solana is. Ethereum processes between 15 and 30 transactions per second on its base layer. Solana processes over 5,500. That is a huge difference. And in addition, the average Solana transaction costs less than a fraction of a cent, while Ethereum fees range between 20-30 cents and a few dollars during peak usage. For a global institution processing millions of payments or securities transactions, that fee difference is not marginal. It is the difference between a viable business model and one which is not. The technology is the foundation. The ecosystem built on top is the signal of the growth potential of the chain. Solana ranked second only to Ethereum for new developer inflows in 2025, adding over 11,500 new developers to the network and demonstrating how popular Solana is as a basis for crypto applications. Stablecoins on Solana reached a market cap of over $14 billion at the end of 2025, up 3 times in terms of volume compared to 2024. Overall, Solana's applications generated $2.39 billion in revenues in 2025, a 46% increase year over year. The developer base is growing, the applications are generating real income, the institutions are committing real capital, but having the best tech is not so important to you if you are a crypto investor. What you really care is something else. When Visa settles payments on Solana, when JPMorgan issues commercial paper on Solana, when a DeFi protocol generates $100 million in fees on Solana, how much of that value flows to Sol holders? This is the critical question. And the answer is not very much, not automatically. Here's the mechanics. Transaction fees on Solana go to validators, the operators who run the network's hardware. There was a governance change in 2024 that redirected 100% of priority fees to validators, rather than purchasing coins and burning them, which supports the coin's value. After the change, the burn was weakened at exactly the moment the ecosystem was growing. Now, compare that to Hyperliquid that I covered in a recent video. This is a decentralized derivatives exchange. Hyperliquid burns 99 of its trading fees directly. Nearly every dollar of trading volumes on the platform reduces the supply of HYPE, its coin. The connection between business activity and coin value is direct and measurable. The business is growing, but the Sol holders are not benefiting proportionally. In traditional finance, we would call it as a value capture problem. The community is working to address it. There was a governance proposal for setting rules for burning. If adopted, with Solana's rising ecosystem activity, more stablecoin transactions, more defined volume, more institutional settlement, Sol price would be supported and we would see a better alignment between the ecosystem growth and coin value. Value accrual is the long-term question, but there is a more immediate form of return that Solana already offers today. This is concrete, live, and meaningfully higher than what Ethereum provides. The staking yield. It is the yield that holders earn in return for locking up their coins to help validate transactions. The comparison is notable. Ethereum staking currently yields around 4 to 5% annually. Solana staking yields between 6 and 7% annually, with roughly 65 of all circulating SOL currently staked. Now, an important caveat that I want to be direct about it. Solana's higher yield partly reflects the fact that the network issues new tokens every year to fund those rewards. In traditional finance, we would call it dilution. If the inflation rate is higher than the network's real fee-based income, existing holders are being partly paid in newly printed tokens. The gross yield is 6-7% as we said, but the net yield should be adjusted for inflation. So the ecosystem is growing, the institutions are building on it, the technology is genuinely impressive. So why is SOL down more than the other major coins? There are three honest reasons. Solana is a high volatility asset. When the broader market falls, Solana falls further. When it rises more. Bitcoin's annualized volatility runs around 40%, Ethereum is around 60%, and Solana is around 80%. Roughly double than Bitcoin and 1/3 higher than Ethereum. This is an expected behavior of a younger, higher growth asset with smaller market cap and thinner liquidity than Bitcoin and Ethereum. In a weak market, as we have seen in 2025 and 2026, that volatility works against you. In a recovering market, it works in your favor. The same characteristics that made this decline painful is what will make the recovery sharper. Institutional investors who understand how blockchains work can see that Solana's fee structure does not route revenues to coin holders in the way they would expect. This structural ceiling is visible to sophisticated capital, and it limits how aggressively they will bid up the coin. Two structural overhangs that have nothing to do with the technology. The first is the FTX and Alameda legacy. When FTX collapsed in 2022, it held a substantial portion of all circulated SOL. The bankruptcy estate has been releasing approximately 200,000 SOL every month since early 2024, following a court-mandated selling process to repay creditors. The largest single event was March 2025, when over 11 million tokens, equivalent to over $2 billion at that time, were released to the market. Around 5 million SOL remains in the estate and will continue to be sold monthly through 2026 and 2027. The second overhang is meme coin dependency. Much of Solana's 2024 and 2025 price performance was driven not by institutional adoption, but by a wave of speculative meme coins. The launch and trading of meme coins generated substantial revenues to Solana. In February 2026, that wave ended. Volume collapsed, daily network revenues fell, and active addresses dropped. We have looked at the tech and the data, but as an investor, you don't just buy a coin, you build a portfolio. Here is how I frame Solana's role in a professional portfolio. Solana is not an Ethereum replacement in a portfolio. It's a completely different bet. Ethereum is infrastructure with deep institutional roots. 60% of all tokenized real-world assets and the most established developer ecosystem in crypto. It is a defensive anchor in a crypto allocation, the incumbent with a structural moat. Solana is the higher risk, higher potential position. The technology is purpose-built for what institutional finance needs. The use cases, payments, settlement, tokenization are live, not speculative. The staking yield at 6-7% is meaningfully higher than Ethereum. And as a high beta asset, when macro conditions improve and risk appetite returns, Solana historically moves faster and further than either Bitcoin and Ethereum. If you believe in DeFi, stablecoins, and real-world assets, both Ethereum and Solana are positioned to benefit from their growth. Solana adds explosive upside to a Bitcoin and Ethereum crypto portfolio, but carries more risk. Here are my 3 bullish themes for the next 12 months. The same volatility that has amplified the decline for Solana will amplify the recovery. Therefore, Solana is better positioned than Bitcoin and Ethereum when the market turns. This is a typical high beta place in a bear market. The FTX overhang will end. Approximately 5 million SOL remains in the bankruptcy estate. At the current release pace, the structured selling will be largely complete within 12 to 18 months. And when this monthly process disappears, one of the most persistent sources of downward pressure will be removed permanently. If tokenomics reform succeeds, the value capture gap closes. If the new governance passes and base fees are burned, the rising ecosystem activity would directly reduce SOL supply. The alignment between ecosystem growth and coin value that is currently missing would be established. That changes the structural investment case. And now, three bear cases. Three risks that could extend or deepen the current weakness. The huge meme coin launching and trading activities that took place in 2024 and 2025 have collapsed. Without the meme coin business, it is hard to foresee in the short term the institutional use case growing fast enough to replace those revenues. If the new governance is delayed or rejected, the disconnect between ecosystem activity and SOL price continues. The network generates $2.4 billion in application revenues, but very little is transferred to coin holders that are not set to benefit from the ecosystem growth. Ethereum holds approximately 60% of all tokenized real-world assets and dominates institutional DeFi. If the next wave of institutional products is built predominantly on Ethereum, the addressable market for Solana's institutional thesis narrows significantly. My verdict: Solana has the technology, the institutional traction, and the ecosystem growth to justify serious attention. The coin will not fully reflect that until the value accrual mechanics are clear and the speculative overhang from FTX ends. Thanks very much for watching the video. I have a background in investment banking and hedge funds. I believe in looking at crypto with traditional finance lenses, with no hype and no fear of missing out. Just sound business analysis and fundamental reasoning. If you agree on these principles, please put a like to the video and subscribe and join me in this journey. Before saying goodbye, a quick disclaimer. This video is for educational purposes only, not financial advice. All investments carry risk. Please consult a qualified financial advisor. Thank you and see you in the next video.